You know, in business, it's often the smallest details that have the biggest impact. And today, we're going to dig into one of them, inventory. Yeah, it sounds simple, right? Just stuff on a shelf. But as we're about to see, how a company accounts for that stuff, well, that's a powerful strategic tool that drives some of the most critical business decisions out there. So let's jump right in with a question. Think about a furniture company. Is a big pile of lumber the same thing as a beautifully finished chair, one that's ready for the showroom? Well, of course not. But the real magic is in how and why a business makes that distinction on paper. That's the key that unlocks its entire financial story and its strategy. And this is exactly why inventory is so much more than just stuff in a warehouse. The labels we decide to put on these items, lumber, parts, finished chairs, they have these huge implications that literally ripple through the entire organization, from the factory floor all the way up to the boardroom. Here's the absolute core idea. Deciding what to call something isn't just a boring bookkeeping task. No way. It's a strategic act. That simple classification is how a company tells its story, how it communicates its value, its efficiency, and its potential to investors, to lenders, and to its own leadership. So to get this right, managers have to speak the language of inventory, and it all boils down to sorting everything into three main buckets. Let's break them down. This table really lays it all out. For a simple retailer, inventory is just merchandising. Things they bought that are ready to go on the shelf. But for a manufacturer, it's a whole different ballgame. They start with raw materials. That's our lumber. Then there's work in process for all the partially built items. And finally, finished goods. Every single one of these classifications represents a completely distinct stage of creating value. Okay, so we've sorted all our physical stuff. But the big question is, so what? Who cares? Well, this is where it gets interesting. This is the link between a real object on a shelf and a critical number on a company's financial statements. And just a quick refresher for everyone, remember that financial statements are basically the official report cards of a company's health. You've got the balance sheet, which shows what a company owns and owes, and the income statement, which tells you if it's actually making money. These are the documents that leaders and investors absolutely live by. And this just illustrates the flow perfectly. First, you classify the item, our piece of lumber. Then, its value gets reported on the balance sheet as an asset, something the company owns. Now, when that lumber becomes a chair and it's sold, its cost moves over to the income statement. That's where it's analyzed against the sale price to figure out the profit. And all of this leads to that final crucial step. Leaders use these accurate numbers to decide what to do next. It's a direct line from a simple label to a major strategic choice. Okay, so let's zoom out a bit and look at the real-world impact of all this. This is where accounting stops being just about looking at the past and becomes a tool for actually shaping the future of the company. I mean, the contrast here is just night and day. On the left, with proper classification, everything's clear. You have an accurate financial picture. This means you can do smart, informed strategic planning because you know exactly what you have and how profitable you are. But look at the right side. If you get it wrong, you end up with a totally distorted view of your company's health, and that leads to bad investments. And maybe worst of all, it tells the whole world your company is worth something it's not. And the cost of getting that picture wrong is incredibly high. We're not talking about a minor clerical error here. Getting this one seemingly small detail wrong can have absolutely severe consequences for the entire business. Just look at these impacts. Misclassification directly warps your financial health. That bad data leads managers to make poor strategic decisions. Maybe they order a ton of raw materials when they're actually swimming in finished goods. This means your money, your capital, gets tied up in all the wrong places. And ultimately, it means investors and banks can't really judge what your company is worth, which can mess with everything from your stock price to your ability to get a loan. So if you remember just one thing from all of this, let it be this. That simple act of labeling what's in your warehouse isn't just about organizing shelves. It is a foundational decision that directly impacts how you build your company's future. And that leaves us with a final, really powerful question to think about. If something as basic as an inventory label carries this much strategic weight, what other simple rules are out there, quietly shaping the entire business world around us? It's just a powerful reminder that in business, strategy often starts in the most unexpected places. Thanks for joining me.